Hey, good morning, everybody. It's Hammer. Today is Tuesday, August 4th, 2026. I, of course, am Hammer, the founder of Hammer Solutions, home of great products such as Originator Success, Grab and Go Social, and Rate Sensei. Products to help my originator friends get more business from Google, social media. Check them out. Be sure to see how we can help you. Remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, broadcasting on Facebook and YouTube. I go live to tell you what's going on with rates and pricing and what's going on in the markets and the headlines. Glad you could join me. As you can see down at the bottom, we've got a pretty good outlook. We're still cautiously floating. Stick around. I'll tell you all about why and what's going on. Welcome to all the live folks. Mike Tebow, Yasmin Martin, Rob Stewart, Angela Walters, Sean Segaloff, Vicky McSweeney, Tim Klyla, Jared Vincent, Patrick Campbell. Great to have all of you here. And Segaloff, I get you. I get you, man. If I know, right? It's amazing. I can be zoned in on something, and within a minute, I can lose track of it with the shiny button. So great to have you here, my friend. Great to have you here. Jesse Lynch, Carolina Small, Robin Davis. Great to have all of you here as well. All right, my friends, remember, if you want a quick reminder that I'm going live so you don't miss a moment of the show, sign up at hmr.io/reminder or use this cool QR code over here. I do send out a text a minute or two before I go live to help you join. And also, remember, you could sign up to get a copy of our written email lock advice, www.ratelockadvice.com. Check it out and get a copy to your inbox each and every weekday morning. This is what it looks like. Let's go ahead. We'll take a minute and use it for some of the highlights this morning. We'll kind of go. We got everything right there for you. Also, don't forget to check out our text alerts, www.ratetextalerts.com. We send out a morning alert, an afternoon wrap up, and then alerts when there is reprice risk, if things are getting better or worse. Help you protect your pipeline. You don't have to spend a lot of money. It's $7 a month to check it out. So all of that said, let's go ahead and get to the good stuff here. Quick recap of what happened yesterday. Yesterday saw bonds start the day with some stellar gains, with the 10-year dropping below 4.7 and mortgage bonds recovering most of Friday's losses. Let's take a look at that and see what that actually looks like here. Let me move the get rid of this. There we go. Let's move this over. Just bear with me a minute. I'll get this lined up and we'll go through this together. So, all right, let's refresh this happy boy. There we go. So we can slide it over. All right. So taking a look yesterday, if you remember, we had a very big increase in the morning. You can see that here. This was Friday. This section right here. This is Monday right here, the section between these here. So coming from Friday, we saw mortgage-backed securities, big jump on the day. We lost a little bit of ground, but by the time pricing came out, we were still quite a bit better than where we had been on Friday. Not quite where we had been on Thursday, though. We did see bonds improve through the day. Go ahead and put this on 2-day. You can see that we just, especially late afternoon right here, we got that little bit of a blurb of improvement. Not enough for lenders to reprice, but it was enough to see, some nice momentum, give us a reason to flow into today. Now, I have to ask you guys, though, yesterday we saw a very big jump in bonds. You can see that here in the Japanese candlestick chart. Friday was a really rough day. Remember, a red candlestick, what this means, the top part of the fat part, this is the body, the fat part, right? So the top is where we started. The bottom on a red candlestick is where we ended. Mortgage bonds lost ground on the day, which means worse pricing. The tail, the little thin part, that is the worst level that we hit, but we closed a little bit better. And then when you have a wick, that's this top part, that means that we were up as high as that level on the day, but closed higher. When it's a green candlestick, means it opened lower, but closed higher. So we've got our red and green candlesticks. Now, yesterday, we did see improvement. Remember, we ended the day all the way down here on Friday. And yet, here we are all the way back up almost to where we started the day. We started the day at 99.27 and we were at 99.25. So we almost were broke even. But yet, according to Mortgage News Daily, there was barely a blip of improvement on rate sheets. You're going from 6.83 to 6.82. That's nothing. That's terrible. Did you guys see? I know I did see somebody mention UWM that they priced out a deal and it really didn't price out different on Monday than it did on Friday. And that should not have been the case. You should see much better pricing. And in fact, we should be back this morning to around what we saw on Thursday. We're almost exactly the same. And when you take a look at mortgage-backed security pricing on Thursday, we ended the day at 99.30 and right now we're at 99.40. So it should be better than what we saw on Thursday, right? If you go back on Wednesday, we were at 99.23. So you go all the way back here to Tuesday at 99.47. So we're working our way up that way. And Tuesday was, gotta lift the glasses so I can see, that was the 28th. So that was 6.76. So you should be, right around the 6.77 mark this morning is what we should see Mortgage News Daily. You should see better pricing. You should see pricing equivalent to what you saw on Thursday. Let me know in the comments. I'm curious if this is legit. With what Matt Graham saw, did you guys see the same thing where we didn't get pricing improving yesterday? Brandy said she does not like the early text. I want to see your face as soon as the text comes out. Otherwise, squirrel. I think you're right. I think I might go back to the old one. Sean said UWM pricing is horrible, but a few lenders checked, didn't go with the market yesterday. And I just, maybe they weren't trusting it. Maybe they didn't trust the overnight, the overnight improvement that we got over the weekend. So that means you should see better pricing today. And that's the reason we talked so long about that. So today you should see better pricing. It should be, if you saw pricing yesterday that really wasn't that difference, you should be about an eighth better, realistically, in rate. It's quite a big difference. Reprice risk on the day today is low. There's not much going on. 10 a.m. Eastern time, we're going to get the JOLTS data, job opening labor turnover survey. I don't think that it's going to show that much weakness in the labor market. A weak labor market would help bonds. Strong labor market will kind of pressure bonds. I don't think we have to worry too much about that. I'll tell you what, when we're looking at everything, here's the deal. Right now, we've got Scott Bessent, who he's our Treasury Secretary. As many of you know, he's also one of my favorite folks in this administration. I try not to get too deep into the political weeds, but I didn't know anything of Scott Bessent before he took over as Treasury Secretary. But this man has just shown to be a steadying force in Trump's tumultuous administration. He just doesn't seem to rock the boat. Trump, leaves him alone. When Scott Bessent says something, it's usually legit and it's true, not like the hyperbole. Trump will spin things and flip things and turn them around. And again, this isn't really political. It just is what it is. You have to look at that. But when it comes from Bessent, it's something that's got a little more gravitas, right? Because he really does nail it. Now, I don't know why the Treasury Secretary is the one that's talking about how we may have a deal to open the Strait of Hormuz. But if he is saying it, I'm listening, right? So Bessent said there may be a deal Tuesday or Wednesday. Maybe we do see something today. Remember, there is a huge time difference between here and Tehran, but I don't know where the negotiations are going. So it might not happen till late in the day. Let's see. What time is it? What time is it in Tehran? So it's 5 p.m. versus 9 a.m. So, you're not going to see something happen late in the day in 8 hours because it's going to be in the middle of the night. So maybe something happens over the next few hours would be cool. Otherwise, it might not happen till tomorrow. I don't know where the negotiations are happening, though, but that's just something that comes to my head, and I'm over here. Ron Siegel said, Scott Bessent is like E.F. Hutton. Yeah, just the dude's just a classy guy, and he just, he seems to do his job well. Again, I don't know why he's saying this, but here's the deal. Oil prices, Brent crude, look at this. It likes what it hears. It is dropping. We're right flirting to get break down into the 70s again. Remember that just a week ago, a little more than a week ago, it was back up to $100 a barrel, closed at 100.69. And yesterday it was at 83.77. On Friday, it was at 90. So just so we can kind of compare, Friday was at 90, then at 83.77. We'll call that $84 this morning at 84, and likely to continue to work its way down and stay down into the 70s here and into the 79, maybe 79, $78 would be fantastic. And if you take a look here, I mean, back in February, this is back in February right here, where before we had all the mess. Remember, mortgage rates at the end of February, mortgage rates were a happy day at the high fives. And so now what we're looking at, this was back down at 70, 71, 72. And then that's when, boom, that's when everything hit and it bounced up. So, we're not that far off from where things were here. What is very different, though, rate sheet pricing. We're almost a point higher than where we were. There is a lot of room to go down. The thing is, here's one of the things that's stopping it from going down. It's expectation of Fed rate hikes. The Fed has not hiked rates since 2023. Markets were pricing in right now, mortgage rates reflect the idea that we will absolutely see a rate hike this year, possibly even 2 hikes, about a 30% chance, 36% chance that we'll see 2 or more rate hikes this year. Markets pricing in a 45% chance we will see 1 hike. And if you want to say a minimum of 1 hike, it's an 81% chance that we will see 1 hike by the end of the year. Now, in September, remember, there were expectations just a little while ago, almost 50%, that we would see things stay the same. Then it dropped, and we saw this side, which is a rate hike. This is a rate hike. We saw this go up and up and up, right? The expectation of a rate hike, even a day ago, it was at 67%. Look what happened this morning, though, down to 56%. Look what happens over here, 32% up to 43%. What's happening is that markets are now growing more optimistic that there will be a deal in the Middle East. The Strait of Hormuz will open. We will see commercial traffic. We will see oil moving through the Strait of Hormuz, and that will help oil prices drop back down. Lower oil prices, lower inflation. All of this stuff is really favorable to bonds, and that's why you're seeing the 10-year Treasury yield was at 4.74 on Friday. Look at how high it was here on Friday, 4.74. Now it's 10 basis points lower, 4.64. 4.64. That's a huge drop in a couple of days with the 10-year Treasury yield. Look at this beautiful ski ramp we see. And when you put that in the 5-day perspective, it's even better because we went from Friday down here. Look at where we are. So you should be seeing much better rate sheet pricing than what we're seeing. On Friday, when pricing came out around 10 a.m., you could argue it was at 99. We're almost 50 basis points higher at this point. That's at least an eighth of a point in rate, generally an eighth of a point in better pricing on top of that. Close enough that you can fight your way to a quarter with a little bit of a buy down. So, we really should be seeing some better pricing. I really expect to see rate sheet pricing improve here, which is why we continue to float. Now, what about later in the month and where we'll be? Let me show you the commentary and kind of go from here. Again, I'm going to throw this up on the screen because you want to sign up to get the emails. The emails are quick and clean. Taking a look here, you've got rate sheets today should be better, right? Over the next 15 days, you've got everything that's going on that we talked about. Now, 15 to 30 at the end of this month, we're going to have jobs data this week. We're going to have inflation data next week. And, markets could really start to give up the idea that we'll need to see a Fed rate hike. If we see inflation that can at all be spun into a positive spin August 12th with the CPI inflation, and we see oil prices down in the 70s, you're going to see expectations of Fed rate hikes start to disappear. And that will help to improve mortgage pricing because mortgage pricing currently pricing in at least 1 Fed rate hike this year, possibly to come in September. And if that starts to fade away, then that leaves room for rates to improve. Now, how much could rates improve by the end of August? Maybe an eighth, another quarter from now. Probably not much more than that. We need to really see a few other things start to fall into place to see it go lower, and that could happen. It'll take a few months for rates. We would have to see things work favorably, inflation drop, all that stuff for quite a while to see rates drop down into the low sixes. But we could get back down into the mid sixes, and that's enough to spur everything. So hopefully that's where we get, my friends. That's it for today. Hope that helped you. Let's go ahead and look at your comments, see what you guys have to say. Ron Siegel said the spread is growing. He highlighted the growing spread on your weekend update last week. We're up to 218 as a spread. 1.79 is the historical spread. The spread that Ron is talking about is the spread between mortgage-backed security pricing and the 10-year Treasury yield. So that's the spread that he's talking about there. We did see that improve quite a bit before it's kind of worsened again. So we'll see. On Friday, the closing spread was 30 basis points. Today it's 48 basis points. Yeah. And that's what Ron is pointing out here. I don't know if it'll show up in the end of the comments. Yeah. So what Ron is pointing out here is when you look at the improvement on the 10-year Treasury yield, and what we've seen with this 10-year Treasury yield, where we're 10 basis points better here, and yet mortgage-backed securities have jumped from 98.91 up to 99.50, and rate sheet pricing really not reflecting that. So there's room, according to this 10-year Treasury yield jump, to see bonds improve even further and see mortgage bonds improve even further, which would help mortgage rates. But all right, let's see. Not much improvement from several. Yeah, I just don't get that. 20-year Treasury versus 30-year. Oh, okay. Is what you're looking at too. So he's looking at short term. I didn't even bother with looking at the 2-year to see what that was. 2 to 10. All right, my friends, I'm going to wrap it up. I hope y'all have I think you mean 10-year Treasury versus 30-year FRM. I don't know what FRM is for you. So anyway, hope this helps you. Let me know in the comments. You guys have a fantastic day. I will see you tomorrow. Take care, everybody. Bye-bye.